At the desk. So it's such a pleasure having you with us today.
It's good to be with you, and thanks very much for having me.
Fantastic. Let's touch on the overall market trend that we've seen following the release of the U.S. non-farm payroll figures just last week. At this time, we saw Monday, Tuesday, Wednesday, the markets were in negative territory and there was nervousness across the board. But today, it does seem as though we've managed to rebound, and the Nikkei reaching new all-time highs once again.
That is correct. It is all about tapering. Well, it used to be at least about tapering. Now it's all about interest rates.
Yes.
Every time we get a better data, what market is thinking that, okay, we are going to have an interest rate hike, and there are all of a sudden everyone is just shedding tears that, okay, we are not going to have a cheap money in the market now, so market starts falling off from there. But soon we get any weaker data, as like today, consumer sentiment, and the PPI data. Because why PPI data is very important? Because inflation has become another important element for Fed, what they look at. So the next week meeting on Wednesday, that's going to be very important. What traders are looking at if they're going to remove the word patience out of that. Because if they do, that means that interest rates are going to go up very soon. If that happens, you're going to see another sell-off on the market. But here are a few things. I crunched a few numbers for you, especially for you. And I'm going to go through each individually, one of them with you. I'm going to see, like, okay, if there is a value in the market. The last time we had a NASDAQ at 5,000 level, or at that point, and if you compare that to when we had a bubble back in 2000 or back in 2008, how cheap the market is. If you look at the PE ratio and compare that to 2000, the PE ratio at that time was 29 and now it is 20.5. So clearly on the price to earning ratio, market is very cheap. But if you look at price to sale ratio, that was 2.1 back there and now it is 1.8. But the most important element, all of them, these are the fundamental values which any investor will look at. Okay, if the market is cheap or whether the market is expensive to buy, are you going to be focused on whether the Fed is going to increase the interest rate or whether they're not? No, you don't look. Yes, you do look into these things, but the most important affair which you wanted to focus on is market is cheap or is expensive. So let's look at the dividend. The dividend for S&P back in 2000, they was 1.2, and now you get 2%. So, I mean, it is everything black and white in front of you. If you think the market is cheap, you go ahead and you buy it. Exactly. But dollar is gonna go up because one way or the other, Fed cannot leave interest rates where they are. They have to bring them back to normality.
The timing is the issue.
Timing is exactly the issue, because it's a very interesting point that she brought up, because timing is the issue. We have divergence in different parts of the world. We have a European Central Bank going for quantitative easing. And as you mentioned, Nikkei. Why Nikkei is hitting all-time highs, or again, just riding up and up, is the tide of quantitative easing, which is sailing the boat.
Having said that, doesn't this mean that it's a good opportunity to get exposure to European markets since they started with their ECB stimulus recently?
Absolutely on that, because if you look at the fund flows, you will see smart money moving into European markets. And you look from the valuation perspective, they are a lot more attractive. What you are risking for and what you get, they are a lot more attractive. Since ECB only started this week, right? But the ECB has already had effects of this one. The impacts are already there. We are seeing data a lot more improving what it was before. So certainly European markets are very cheap. If you wanted to, if you have a little bit appetite for a risk, then you go towards European markets. But if you are a risk-averse investor, then you can look into US markets. But remember, the ups and downs gonna be there. The US will increase the rates. It's only a matter of a time. If not June, then September.
Exactly. But Naeem, I want to pick your brain on what this means for emerging markets, because once the US picks up its interest rates, and we know that the currency is strengthening, that the US dollar in particular has had a negative impact on EMs, especially countries like South Africa for the moment, could things potentially get worse once the Fed gives it the green light to increase interest rates?
It's a very important question which many investors wanted to know, and I'm glad that you put it to me. What's going to happen every time a developing market or developing currency is increasing the rates, their currency is going to go up. And the most impact of that you will see in the emerging markets, such as Rand or Turkish lira or any other currency that you pick up in the emerging markets. It's been hit really badly. But that's just the normality of it. But it is getting hit on both ends because we have oil. And that is the crucial backbone for countries like South Africa or other commodity-based countries. So you're basically getting hit on both sides of the equation. You get a hit from here with the crude oil, and then you have a Federal Reserve Bank increasing the interest rates. Exactly. So things are extremely difficult in that arena.
So clearly it means that economies like Nigeria are slightly more difficult. At least in South Africa, we're getting the inflation pressures relieved slightly on the back of the crude oil price increase.
That is absolutely true. But I think there's a silver lining to it. Because when it comes to crude oil, it is all about demand and supply equation. And now that equation is completely out of whack. We do not have a balance between them. And who did it? It's obviously the US shale oil, which came on the market, and now Saudis do not have that much of a power. Yes, they are trying to curve the market. They're trying to just put US companies out of the game so that they can become a major influence once again on the market. Whether that would happen, you certainly don't know. But an example of that would be ExxonMobil. What they did, they are one of the major players in the US oil market. They have literally announced that we are going to double our investment. We are going to need to double our output or production of oil because they wanted to make sure the future is safe. And they're going to spend that money abroad. They're not going to invest that money within the US because producing oil within the US has its cost, and which is a lot more cheaper if you compare that to Middle East. Exactly. So what I would say in terms of oil, I think I always said it on TV. I said if it falls on up to $20, which many investors would say that, okay, it can go to $20. I would say if it goes to $20, I'm going to buy Homer because I'm not concerned how cheap, how much my car is going to take. Because $20, I can afford that oil. Exactly.
Naeem, thank you so much for your time today and for joining us here in our studios. That was Naeem Aslam, who works as a Chief Market Analyst at AvaTrade. Well, do stay with us because coming up on Closing Bell, we turn our attention to Namibia with Dumisho Greater giving us the country's investment case and a look at its economy. Do stay tuned.
In 2015, Africa's biggest business award returns to recognize the continent's greatest business minds and celebrate their epic achievements.
We'd like to thank CNBC Africa for creating this award.
Feel the passion.
This is not a European award. It's not an American award. It's an African award.
Witness the victory.
It's a particularly proud moment for me to be here this evening. I'm honored, I'm humbled.
And dare to dream again.
We stand here humbled on the stage because we stand on the shoulders of giants.
From East, West, and Southern Africa, the 5th Annual All Africa Business Leaders Award in partnership with CNBC Africa. Nominations are now open. Go to ablaawards.com today.
If you're paying for bulk data fees that give you information you don't really need and in a format you don't really like, you need to talk to Profile, specialists in financial markets data. Profile, customized data solutions that work.
Another very common mistake for entrepreneurs is forget about the systems and worry about the sales. And the reality is it should be the other way around. Make sure you've got foundations, make sure you've got systems.
Closing Bell is brought to you by RMB, a leading African corporate and investment bank that provides innovative financial solutions for clients across the continent.
Welcome back. You're still watching Closing Bell Africa, and for this particular segment we'll be traveling again to the southern part of Africa, and this week we take a look at Namibia. On the line now to tell us about all things that is Namibian is Daniel Kavishe. He's from Storm Securities and he is an economist there. Daniel, thanks so much for your time. Let's start off with some of the economic data that we've received. The vehicle sales seems to have jumped for the month of February, but what has been the ongoing trend, and most importantly, what does that tell us about the state of the Namibian economy?
Thank you, Tanisha, for having me. From last year, we've been noticing the vehicle sales coming into Namibia has been increasing quite substantially. We had periods towards the end of last year where year-on-year growth was as high as 50%. The recent numbers indicated that sales came in at just over 1,900 units, which represented just about 13% increase in vehicle sales. But like you mentioned, the trend tends to be more important. What's happening is that consumption, both private and from the government perspective, increased during the course of last year, with some people speculating because of the fact that it was an election year, more vehicles were needed. But then also the fact that we had low interest rates within the market. It spurred a lot of entities within the country to take on additional debt, and of course to try and take on debt, on the basis of taking on cars. We also noticed, of course, in other metrics, is that mortgage loans also picked up during the course of last year. And now recently, like you'll be seeing, is that we had an interest rate hike during the early first quarter of this year, and that should start tapering the credit uptake within the country.
It's going to be a busy 2 weeks ahead. We are expecting some key economic data, and one of those being the GDP print or the trade account. What are the key things that you are looking out for in terms of where the growth is seen to be coming from?
Well, Namibia has always been well positioned as a good country for a lot of foreign direct investment, particularly in the mining sector. And we've seen a lot of that taking place during the course of 2014. Additionally, we saw quite a big spike in increase in construction activities. In some quarters, it was recorded as high as 30% year-on-year, mainly on the back of improvements in terms of logistics within the country. So that's not only the roads that are being built, but
let's now look at the trade data that we're also expecting out in the next 2 weeks or so. Looking at these vehicle sales, they account for about 14% of imports. That particular number has been increasing for the last couple of months or so. Looks as though we may have lost Daniel for now, but just some interesting stats. We did say for the next 2 weeks it's going to be proving to be quite a busy week. What we do have lined up is the national accounts, as Daniel was telling us, where we're most likely to see a growth coming through from there. The trade balance numbers will be out, and we are seeing the amount of vehicle sales that contribute to the import bill. We also have the announcement of the new parliament, and we are also will be celebrating 25 years of independence over in Namibia.